The bond market is arguably overbought, but given QE and the way that this has created a false market in equities for an extended period of time, and also the low rates, promises made by central banks recently, should we really be concerned?
We should be concerned about the bond market because it's much bigger than the equity markets, and if you think about it, in a world of debt, bond market is the replication of that. It's people selling debt instruments for other people to buy. It's a brilliant and important signalling mechanism. So how do I think it's all going to work out? Well, I say you need to look again at who ultimately is holding debt. And I go back to the US Treasury market because ultimately that is the biggest bond market out there, and you need to think about that one first. With the Chinese and the Japanese holding a large amount of debt, ultimately, whilst they would support stabilisation and QE and other mechanisms to keep the global economy moving forward, or at least not going backwards at the moment, at some point they'll have different interests. In Japan, an economy which itself is groaning under a bunch of large debts, both at the government level and to some extent the individual level as well, but predominantly the government, they've got different problems and they'll need to bring money back ultimately in order to support their system. So I think that's a negative and that's a problem. And the Chinese also, when you think about their medium-term observation, they want the West to remain economically okay for them at this moment in time, but as their domestic economy improves and domestic consumption becomes ever more important, there may come a moment in time where their objectives may be no longer to prop up the US government bond market or other government bond markets of the world, and consequently that will also lead to higher yields. So I think medium term there is no value in bonds. You know, at current rates of yield, negative yields are clearly bonkers, and we'll look back and we'll say, you know, the people who bought negative yielding bonds, what on earth are they thinking? At a certain, you know, I can't even imagine being a fund manager having to justify that as an investment decision. Short term, you can try and justify it off the basis that there are no other alternatives. I think that's rubbish as well, because I can find interesting companies to invest in, and you can put together, if you're worried about overall market levels, a structure where you're a bit protective if markets generally fall down. So I think you've got to be very cautious of bonds at the moment, and I don't see much value at all. And over the medium term, because of the differing drivers of the Japanese and Chinese ownership, you've got some issues. So how do you square that circle? Well, you can, of course, one way, and that is you increase domestic ownership of bonds. Because let's face it, you've got ageing populations who potentially could say, well, hang on, I quite like the idea of an income yielding instrument which is sort of owned by our national government or debt on my national government. You know, it could work. So that's fine. So let's have a think about that. So in order to induce that, you're going to have to offer better rates of interest than you are at the moment. So that also means bond yields going up, which kind of means bond prices coming down. And second, that also means more saving in the Western world, because if you look at the States or the UK or other Western economies, savings rates are generally pretty low. So if you have to move to a world where you have to encourage domestic purchasers, consumers, to buy more domestic government bonds rather than rely on the Chinese and the Japanese and others, then you're going to offer a bit higher rates, and it's going to mean more saving, less consumption. So that's bad for local economic growth as well. So you put all of that together and you have to conclude that really if you're somebody who wants to see economic momentum and great economic advance and the like, then you better hope this bond market, bull market continues, because if it doesn't, the consequences are you're going to get more volatility, lower growth and lots of hassles. So my betting is that is probably the world we're moving towards, and that means ever more you've got to look for flexibility, you've got to look globally, and you've got to look at a number of different asset classes to make returns, which I think inevitably drives you towards things like equities, protective strategies around things like volatility, but also things like foreign exchange as well.